How many Americans are going to get blindsided by their tax bill in retirement? More than you'd think. A lot more. And once you see exactly how the math works, it will all make sense. Here's the thing most people do not realize going into retirement. You spent decades building up a traditional 401k or IRA, deferring taxes on every dollar you saved, and that was the right move at the time. But there is a moment, a very specific moment, where the IRS flips a switch. And suddenly all those years of tax deferral come due at once, in a way that stacks on top of your Social Security, on top of your Medicare premiums, on top of any investments you sell that year. We call it the tax bracket trap, and most people walk right into it. So let's define exactly what we're talking about, because there are a few moving pieces here, and understanding each one changes the picture completely. The first piece is something called an RMD, Required Minimum Distribution. Under the Secure 2.0 Act, which passed in 2022, the IRS requires you to start taking withdrawals from your traditional 401k or IRA beginning at age 73, whether you need the money or not. You cannot leave it in there indefinitely. The government wants its tax revenue, and after decades of deferred growth, they come to collect. The second piece is Social Security. Specifically, how much of it becomes taxable based on a formula the IRS calls provisional income. Provisional income is your adjusted gross income, plus any tax-exempt interest, plus 50% of your Social Security benefits. That number determines whether 0%, 50%, or 85% of your Social Security check gets added to your taxable income. And the third piece is Medicare IRMAA. That stands for Income-Related Monthly Adjustment Amount. It is a surcharge, an extra charge on top of your standard Medicare Part B and Part D premiums, that kicks in once your income crosses certain thresholds set each year by the Centers for Medicare and Medicaid Services, or CMS. Now here is the number that should stop you cold. According to the Social Security Administration, approximately 57% of Social Security beneficiaries are projected to owe federal income tax on some portion of their benefits by 2025. 57%. That is more than half of everyone receiving a Social Security check. And this is not because retirees suddenly became wealthy. It is because those income thresholds, the ones that determine how much of your Social Security gets taxed, have not been adjusted for inflation since 1984. Not once. For a single filer, combined income above $25,000 means up to 50% of your Social Security benefits become taxable, according to IRS Publication 915. Cross $34,000 in combined income, and up to 85% of your benefits are taxable. For married couples, those numbers are $32,000 and $44,000. And here is what most people do not understand. Those thresholds were designed in 1983 to affect roughly 10% of beneficiaries, the high earners of that era. Since then, wages have risen, Social Security benefits have increased with inflation, and IRA and 401k balances have grown enormously. So the same fixed thresholds that once touched only the wealthy now hit solidly middle-class retirees with perfectly ordinary income. A couple bringing in Social Security plus a modest pension or part-time work can clear $44,000 in combined income without much effort. And the moment they do, 85 cents of every Social Security dollar is taxable. But here's where things get interesting. The RMD comes in and makes all of this significantly worse. Let's say you are 74 years old with $400,000 in a traditional IRA. At that balance, the IRS requires you to withdraw roughly 4%, about $16,000 that year. That $16,000 counts as ordinary income. Stack it on top of your Social Security check, add in your provisional income formula, and suddenly you have crossed a threshold you never planned to cross. T-row. Price research shows that the combination of RMDs and Social Security can push otherwise middle-income retirees into tax situations that look nothing like what they expected. And every year you get older, the RMD percentage gets larger. By age 80, your RMD rate is approaching 5%. By 85, it's over 6%. The distributions grow as a percentage, even as your portfolio fluctuates, which means the tax pressure typically intensifies over time rather than fading away. So, here is where it all compounds in the worst possible way. Because the IRS does not just tax your RMD as ordinary income, that extra income from your RMD can simultaneously push you past the Social Security taxation threshold, which increases the taxable portion of your benefits, which raises your Medicare IRMAA calculation, which increases your premiums. And if you happen to sell any investments that year, it can knock you out of the 0% long-term capital gains bracket entirely. For 2026, the 0% long-term capital gains rate applies to single filers with taxable income up to $49,450 and married couples up to $98,900, according to IRS guidelines. But here is the catch. Your RMDs and your taxable Social Security count as ordinary income first. They fill up the lower brackets before your capital gains even enter the picture. So if your RMD plus taxable Social Security already puts you at $95,000 in taxable income, and then you sell $10,000 worth of appreciated stock, congratulations, you just crossed the threshold. That $10,000 gain that could have been taxed at 0% is now taxed at 15% because of the stacking. And it is this stacking, this layering of income sources that interact in ways most people never anticipate, that creates what Vanguard has called a significant and underestimated tax drag on retirement income. In their research on tax-efficient retirement strategies, Vanguard found that retirees who use a thoughtful withdrawal sequence and account for these interactions can reduce their cumulative lifetime taxes by roughly 14% compared to those who simply take distributions without a plan. 14%. Over a 30-year retirement, that difference is not small. Now here is the piece that absolutely stuns most people. The IRMAA surcharge from Medicare operates on a cliff system, not a gradual scale. In 2026, according to data from the Centers for Medicare and Medicaid Services, a single filer with income up to $109,000 pays the standard Medicare Part B premium of $222.90 per month. But a single filer with income of $109,001, $1 more, pays $284.10 per month. That $1 of extra income triggers an additional $1,148 in Medicare costs over the full year. $1. And if a Roth conversion, an RMD, or a stock sale pushes a married couple from just under $218,000 in income to just over it, both spouses face the IRMAA surcharge independently, meaning the household cost jump can exceed $2,296 in a single year. Most people have no idea this cliff exists. And the surcharge is based on your income from 2 years prior, which means a one-time income spike today affects your Medicare premiums in 2028. The delayed consequence makes it even harder to plan around. Once you understand that all of this, the RMD, the Social Security taxation formula, the capital gains stacking, and the Medicare cliff operates simultaneously on the same calendar year, on the same tax return, the picture becomes very clear. The practical steps that financial researchers consistently point to are these. The years between retirement and age 73 are a planning window. They are your chance to do Roth conversions, moving money from a traditional IRA into a Roth, while your income is relatively low and before RMDs force the issue. Vanguard's own research shows that over 80% of clients in a tax-efficient retirement strategy can benefit from Roth conversions when they are woven into a broader plan. And T. Rowe Price notes that six-figure lifetime tax savings are achievable for many retirees who sequence this correctly. There is also something called a Qualified Charitable Distribution, or QCD. If you are at least 70 years and 6 months old, the IRS allows you to donate up to $108,000 directly from a traditional IRA to a qualified charity. That donation counts toward your RMD requirement, but because it goes directly to the charity and never hits your bank account, It is never added to your taxable income. For retirees who donate anyway, this is one of the cleanest tools available. The broader point is this: most people enter retirement thinking about how much money they have saved. Very few think carefully about how much of that money will actually be theirs to keep. The tax bracket trap does not hit because you did something wrong. It hits because the system was not built with your specific combination of income sources in mind. And because the thresholds involved, some unchanged since 1984, were never adjusted to reflect how middle-class retirement actually looks today. You deserve to know how this works. And the people who know it earliest have the most options. So here is my question for you. Were you aware that your RMDs could push your Social Security benefits into the taxable zone and trigger a Medicare surcharge, all in the same year? Let me know in the comments. And if this was useful, the next video covers exactly how to run the Roth conversion math for your own situation.